Yeah. Well, I'll jump into a couple of them where that's working. I'll tackle the public input. In our council meetings, we have public input for 5 minutes apiece. And if you look at a lot of municipalities, sometimes they offer 2 or 3 minutes. We offer 5 minutes. And also at all our committee meetings, they're posted online and they are streamed live online. And they're also open to public comment. And I recognize that, government decides to offer public comment. Period is open meeting and provides that citizens may exercise their First Amendment rights, and I support that. So now we can turn to the tax and spending cap.
All right, so one of the things we heard a couple of weeks ago is that we have a tax and spending cap. So we just took a quick look at the charter provisions to actually see whether we have both a tax cap and a spending cap. So next slide, please. The tax cap calculation, there are 2 factors that allow an adjustment in the amount to be raised through property taxes. Thus, that's the tax cap portion. This is per the charter. The 2 factors are an inflation adjustment using the CPI and then added taxable property values called net new construction. So next slide, please. The first adjustment uses an inflation factor pegged to the National Consumer Price Index, urban. And once again, this pertains to tax revenues and not spending. So next slide. The second adjustment to the amount to be raised through taxes is pegged to the amount of net new property value that can be taxed. So that's the net new value. So the next slide. Once again, the 2 factors here pertain to the amount to be raised through taxation, i.e. the tax cap. There's a provision, or a section of 43A stipulates total expenditures for any given budget year shall not exceed the amount of funds reasonably calculated to be derived by the tax rate established herein, increased by the other revenues generated by the municipality. This is the spending limitation portion. Other revenues implies non-property taxes. So next slide, please. So spending is therefore limited only by the amount of available non-property tax revenues, such as waste management host fees, auto registration revenues, grants from federal, state, and other sources, and unassigned fund balance. So next slide, please. Therefore, supplemental appropriations outside the annual budget process are permissible because they are fully funded by non-property tax revenues and do not increase the amount to be raised by property taxation. So next slide.
Yes. So as to RSA 49-C33, there are some indications that this is somehow some other type of restriction on the tax cap, something that needed to be overcome. Well, that's just factually inaccurate. As our Supreme Court stated in T-Boom versus City of Nashua, the purpose of RSA 49-C33D is to address special circumstances and ensure that municipal officials are not handicapped by the existence of caps and meeting local needs. The override provision was intended to grant municipalities flexibility. So instead of being a further restriction on the tax cap, it is actually the safety valve that municipalities can use when necessary to override the tax cap. And again, as the city manager is talking about, when we're talking about overriding the tax cap, we're talking about overriding the limitations on the amount to be raised by property taxation. It does not have to do with these non-tax property tax revenue sources.
Good evening. I'm Deputy City Manager and Finance Director Ambrose. To discuss supplemental appropriations further, supplemental appropriations fall under Section 44 of the Charter as well as transfers. Next slide. There are multiple reasons to bring forward supplemental appropriations. Some of the more frequent that we'll see in Rochester would be grant opportunities or economic development initiatives not aligned with the fiscal year, changes in scope or unanticipated expenses in previously approved CIP projects, transfers to the School Capital Reserve Fund, or other unanticipated needs or emergencies. This chart is a summary of FY22 supplemental appropriations to date. There were 33 total. You can see in the chart this amounts to $17.8 million, which we've categorized into 9 categories. The greatest percentage would be 37.78% for grant acceptance, $6.7 million for ARPA and other grant opportunities that occurred off the budget cycle. The second highest amount technically isn't a supplemental appropriation. After the FY21 audit presentation, finance staff brought forward recommendations to Finance Committee and Council for use of general fund unassigned fund balance to bring the city into compliance with its unassigned fund balance ordinance. One of those recommendations was to utilize $3.7 million to change the funding source from prior approved CIP projects from bonding to general fund unassigned fund balance. And in doing so, that saves the city approximately $510,000 in interest, future interest. Another higher category would be $2.8 million for the Woodman-Myrtle project cost escalations, which was a borrowing funding source. We also recently had an appropriation relative to pump station and clarifier projects. The reason being is that in addition to ARPA grant funds, these projects involve state revolving loan funds, which have a program application due date of June 1st. So that had to be appropriated before we entered the FY23 budget cycle. Additionally, last fall, the school department received $1.2 million in increased state adequacy aid, which was appropriated and transferred to the School Building Capital Reserve Fund. Another staff recommendation for unassigned fund balance to bring us into compliance with the ordinance would be just over $1 million to the Economic Development Fund. Another appropriation that we'll see throughout the year with supplemental appropriations would be use of retained earnings in funds outside of the general fund. So the sewer fund, water fund, economic development, and TIF funds. Anytime we utilize retained earnings in those funds, that requires a supplemental appropriation for projects that occur outside the budget cycle. We also had a supplemental appropriation relative to an intermunicipal agreement that Rochester has with surrounding municipalities. This is linked to our EPA NIMDs permit. And the communities have agreed to an annual contribution, which is on a calendar year basis and is voted on around December timeframe. And then finally, we had an unanticipated donation, which was accepted. Moving on to general fund unassigned fund balance. It's called general fund unassigned fund balance because it is within the general fund. It is not a separate fund. Unassigned fund balance is a balance sheet calculation. Balance sheets track assets and liabilities and measures liquidity. Unassigned fund balance can serve as a measure of fiscal health for Rochester and is a factor in our bond ratings. Total fund balance is current assets minus current liabilities. Next slide. Within fund balance, we have certain classifications or categories. For example, restricted, non-spendable. Unassigned fund balance is the classification given to the net position of current assets minus these other categories, minus liabilities and these other categories, rather. So less assets minus liabilities, less restricted, dedicated, and non-spendable. The net position remains unassigned until it's assigned to a new activity by council. Private sector accounting designates the same net position as working capital, which you may be familiar with. Utilization of unassigned fund balance is governed by city ordinance and requires a public hearing and 2/3 affirmative vote by council. And now I'll ask Deputy Finance Director Sullivan to continue the fund balance discussion.
Hi, Mark Sullivan, Deputy Finance Director. This slide is trying to put a little bit of scale to what we're talking about. You know, you're hearing a lot about slush funds and cookie jars, but what we have to recognize is that we have $530 million of assets under management. So $500 million in total assets. That's all the buildings, all the infrastructure, the sidewalks, the street, everything. The issue with those asset base, they depreciate over a period of time. Some things depreciate quicker than others. Some of the bigger assets will depreciate over a 40 or 50-year period. But it's aging. There's 49% of our total asset base has been depreciated. Now, that doesn't mean that we have brand new stuff, and it doesn't mean that everything's old either. It just means it's entering into the phase that it's aging, and we have to remember to maintain all that is going to require additional capital investments in the future to keep that level of asset base acceptable and safe for everyone. During each annual O&M and CIP adopted budget, when we look at what the cash needs are, they're close to 200 million. There is a fresh appropriation each year of 140 million of all sources, but we still are working off of the prior appropriations, particularly for the capital improvement projects. And the majority of those that are bonded, we advance the cash, complete the project, then we issue the bond to replenish the cash. So if you think a little bit about that for a second, this isn't a small village, it's a growing city with a large asset base. We hold the cash that we have available in short-term investment mechanisms that have to stay liquid. We don't get much of an interest rate on those, but we get enough that we bring that back in as a revenue source. And as we utilize unassigned fund balance, we're doing it prudently and under the provisions in compliance with Ordinance 762. This is a snapshot of the balance sheet as of 6/30/2021. Current assets are cash and cash equivalents. We had $58 million in current assets. We had $29 million of liabilities for a total fund balance of $29 million and a little bit of unrestricted fund balance in there. That fund balance is the liquidity, which is in a 2-to-1 ratio, which is the minimum ratio that you really want to see when you're operating the type of base that we're operating. If that had been 3-to-1, meaning $3 for every $1 in assets, or 4-to-1, then it's leaning the other direction. But you don't want it to see 1-to-1 for sure, because that would mean for every dollar of assets we have a dollar of liability, and there'd be no surplus to do anything. So it looks like a large number, but in the scope and relative to what we're managing, it's really not as large as you might think. So this was the contributions that contributed to the $7 million add to unassigned fund balance in FY21. The school department had unexpended appropriations of $3.3 million, excess surplus revenues of $436,000. I know the school department is here tonight. They can certainly speak to those if there's any questions. We had strong host community fees again, incredibly strong motor vehicle permits that we had no idea was going to be this strong, and that's a testament of, you know, the economy and people being able to afford larger, bigger, more expensive automobiles. True, volume is part of that, but for the most part, it's the price of the automobiles that's used in the calculation to pay the permit. The city had unexpended appropriations of about $5 million. The majority of that was salary and benefits, approximately $1 million. But as we know, we've had hiring issues, particularly in the police department. We've had military deployments in the fire department. Those contribute greatly to the source of surplus in that category. Our winter maintenance came in under budget by about $170,000. Our county tax came in under budget by about $188,000. And then all the other net changes went the other way, took $1 million, a little over $1 million. So then the combined net changes added $7 million to fund balance in FY21. This is a representation of a chart of trying to just show what we've used for unassigned fund balance in the last 6 years. So there's a little bit that's appropriated each year during the adopted budget process. There are some supplemental appropriations. There are some change of funding. There is some special education supplemental appropriations that the school needed in what looks like FY20 and FY18. We do have to do the supplementals for the transfer into the capital reserve funds. We also have on this list the capital reserve funds that the city's contemplating, and also the transfer to the Economic Development Special Reserve Fund. What this slide's representing is of our total FY23 revenue requirement to meet the budget, the blue represents what we're allowed to raise by property taxes, which is 73 million. Non-property tax revenues are coming in at 46 million, and we are using 3.3 million, or almost 3.3 million in unassigned fund balance, and we're trying to pair that up with the cash capital one-time purchases. So this whole scope of the revenue that's needed to support the budget, you can see, is over almost 125 million. But those are the categories of where the revenue sources are coming from. So there's one point out, there are consequences if you do vote to use unassigned fund balance as a direct offset to the property tax revenues. It will be only for one fiscal year. The next fiscal year, the amount to be raised taxes will automatically increase. Tax cap override's a strong possibility. And if you were to choose to do the unassigned fund balance to offset the property taxes, and you were reluctant to do a tax cap override, we might be looking at substantial budgetary reductions in order to supplant that revenue loss. So the better approach that we feel should be unassigned fund balance should be used for is to continue to change bonding projects to cash and continue to fund more projects with cash, eliminate the long-term debt, get that curve going down a downward slope instead of an increasing slope. Every time we do that, you save interest. We save on that principal also from hitting, because the principal and interest will come back in when we do the bond as a amount to be raised by taxes in subsequent years. Continue to utilize capital reserve accounts, invest in those. They return an interest way beyond what we can get in a traditional liquid investment account, and utilize unassigned fund balance for economic development initiatives that will increase assessed valuations. I'll turn it over to Deputy City Manager.
Thank you. So before the council are three proposed capital reserve funds. So just to summarize, we put before you the fire apparatus replacement fund, city building renovations, and then the public works apparatus replacement. So next slide. So we heard questions in response to these proposed capital reserve funds. Why are these CRF items not included in the upcoming annual budget process? Are the funding sources for these CRFs different because they are not included in the annual budget process? And why create these separate capital reserve funds and not simply include in the annual budget process? Additional questions, why are these proposed capital reserve appropriations not a part of a long-range plan? Why would capital reserve fund monies be turned over to the trustees of the trust fund, which incur management fees? And how do these management fees compare with interest earned on investing the funds? So here in this chart, I've just tried to create an example of how one of these capital reserve funds would work. So you can see here an annual constant contribution of the $500,000, periodic annual expenditures. So you see, not every year would there be expenditures out of these funds, but based upon that department's plan for, in this case, the fire department apparatus replacements, you'd have replacements of different amounts over the years against what's in the fund. And that would be based upon the CIP plan. So looking at the next slide, after initial creation and first appropriation to these capital reserve funds, subsequent actions will be a part of the annual budget process. We would be proposing annual contributions to the capital reserve funds. These would require council action and be requested during the budget process. And expenditures from the capital reserve funds will be included in the 6-year CIP budgets, once again requiring council approval during the annual budget process. So the source of funding for these capital expenditures are the same as they have been in the past, even before these capital reserve funds were created. Capital expenditures for fire apparatus have traditionally been funded using unassigned fund balance. And going forward, capital expenditures for fire apparatus using the capital reserve funds would still be proposed to be unassigned fund balance. These proposed capital expenditures are part of a long-range plan. Fire apparatus replacements are included in the 6-year CIP plan. So if you actually look at the FY23 CIP book that you have, on page 37 and page 158, you'll see that these replacements are part of the plan. And for the other two proposed funds, once again, they are in the 6-year CIP plan. So they are a part of the budget process. They have been in the past, and they would continue to be with these new funds. So why create these capital reserve funds? As you saw on that chart I showed you a moment ago, level annual funding approach eliminates large swings in funding requests, which gives us budget stability year to year, provides department heads a better sense of funding levels into the future for planning purposes, and it also requires department heads to look further into the future when they're planning their expenditures. Why involve the trustees of the trust fund? The statute pertaining to capital reserve funds stipulates that the trustees of the trust funds of the city shall have custody of all capital reserves. So that's a statutory requirement. What the trustees do in managing the funds is their choice. Trustees don't have to turn capital reserve fund monies over to the third-party management company, and they could avoid management fees. However, it should be noted that management fees are offset by the rates of return achieved by the third-party management company. The interest income, monies held by the city in liquid investment accounts. Mr. Sullivan just mentioned this a moment ago. When we are holding those in our liquid investment accounts, they do earn as little as 0.18% or as high as 0.30% interest. Because they are fairly liquid funds, they don't earn us very high rates of return. The trustees of the trust fund, however, their treasury bonds are earning 2.7 to 2.9% currently. So if we net that out, net out the 0.5% management fee, the results of the return are about 2% held by the trustees. So it is to our advantage. This chart basically shows an example of that to show how that would work. And once again, using the fire apparatus, the net interest of 2%, when we look forward to out to FY22, just as an estimate, the cumulative interest earned, you can see, is approximately $89,000 or $90,000. So one of the other questions we were asked was, why not use the unassigned fund balance to buy down the tax rate? The answer, and Mr. Sullivan touched upon this a little bit a moment ago, ongoing operating expenses should not be funded using non-recurring revenues. This is a basic budgeting principle. So unassigned fund balance is a non-recurring revenue. And as Mr. Sullivan mentioned a moment ago, if we used unassigned fund balance to buy down the tax rate, this could result in major swings in the tax rate. So use of non-recurring revenues, such as fund balance under a tax cap, is especially problematic. Once the non-recurring revenue is depleted and the tax levy is not able to be adjusted adequately to make up the loss without a tax cap override, unless major cuts in services are made. So that's the problem, using a non-recurring revenue to offset the tax rate. One of the other questions we received was regarding bonding for the new DPW facility. So Ms. Ambrose has provided here a breakdown of the total appropriations for the new DPW facility were $22,525,000. We bonded in 2020 $10,525,000. The balance to bond was left of $12 million. So DPW anticipates a $500,000 surplus in that project, which would be deauthorized. So once again, we did not overbond for this project. We haven't finalized the bonding, and nor could we overbond for a project. One of the other questions we received was the impact of the closure of the landfill. Right now, the estimate is that the landfill would close around 2034. If I was a betting person, I would say it's probably going to be a little bit beyond that. But what will be lost when the landfill closes? Well, obviously the property taxes that we gain from that facility, the host fees, and free disposal of the city's solid waste. How can the city anticipate offsetting this loss? So that's been part of the plan since going back to the Gary Stenhouse days, funneling a lot of the host fees to economic development activities to foster the tax base. Part of that is creation of the TIFs. One of the things regarding having a TIF district is The net new construction in a TIF district is not factored into the tax cap calculation each year. It's kept outside of that calculation. When those assessed values come back in, when the TIF is closed, the way the tax cap is set up, it still cannot be factored in as net new construction. So it's going to be a gained assessed value that will have the impact of lowering the tax rate or offsetting the closure of the landfill. And one of the other questions we had was, or statements that was made about enterprise funds. I just want to point out here that appropriations and supplemental appropriations for water and sewer funds do not impact the tax cap. Those are separate funds. Those are not general fund accounts. So the water fund and sewer funds are enterprise funds. Enterprise funds are supported through user fees, the fees charged for the services that they provide, and they're self-supporting. So once again, supplemental appropriations to the enterprise funds do not have tax cap implications. And then finally, one of the statements was made that, property owners or businesses in the TIF districts are getting a tax break. They are not getting a tax break. Property taxpayers in TIF districts pay a full tax bill. The TIF district simply allows the city to dedicate tax revenues to pay for public infrastructure in those districts. Once again, public infrastructure, not private infrastructure. So I'll turn it over to the mayor to talk about the last item.
Thank you. Thank you, city manager and your leadership team. That was informative. One thing I wanted to add on public input is the inference that we have not discussed these capital reserve funds. We've been discussing them in finance and in council meetings since January.
Mr. Mayor?
I'm almost done. There's one more thing. Oh, sorry. Thank you, Counselor. The free money, that was brought up. Absolutely. There's no such thing as free money. It's federal tax money. And New Hampshire is one of 10 states that consistently is a donor state. That means we pay more in federal taxes than we receive back in services. In the last report that came out in 2019, the state of New Hampshire gave $314 million more to the federal government that we receive back in services. So when we have an opportunity to get these federal grants like the APRA money, we should take it. Another benefit of federal grants is vital for our residents. Education provides formula grants for schools with high numbers or proportions of disadvantaged children to help such children meet academic standards. Education grants from the federal government also provide formula grants to help schools pay for the additional costs associated with teaching students with disabilities. And there's community block grants. They provide grants to revitalize our neighborhoods, provide support to social services agencies, provide loans to small businesses that create jobs for low and moderate income residents. Rochester has a revolving loan fund right now in an amount of just under $200,000, $197,860.50. In the last 5 fiscal years, Rochester has received over $1.65 million in federal block grants. And the other point I want to make on federal grants is the public safety grants. They support our local law enforcement through efforts through juvenile justice programs, community-oriented policing programs, prevention and prosecution of violence against women, and combating drug trafficking. Thank you. Good. Councilor Bowden.
Thank you, Mr. Mayor.
Question for me?
Actually, I do. If it's possible, I'd like to request that the city manager share the PowerPoint presentation with the councilors.
Oh, absolutely.
Thank you.
Sorry, thank you. May I go, Your Honor?
Yes.
I mean, follow up on that. There's a lot of confusion with some of this. When some of the residents were speaking there a couple weeks ago, that if we could put this on, I don't know if Katie or you could put this on the webpage so they could, have a chance to look at it because, again, confusion and I want to say some misinformation was distributed as well. So thank you.
Councilor Gray, do you have your hand raised?
Yes, I do.
Go ahead.
For the city manager, we didn't talk about the ordinance that puts and I'm going to use it in quotes, a limit on what should be in the fund balance and the procedure that should be done for reporting and what should happen to those funds in this presentation. Would you at least give the council a brief explanation of what the ordinance says?
Yeah, so we do have an ordinance and we do have a fund balance policy. The policy stipulates that we should have a target of 8 to 17% in the unassigned fund balance. We're over that, I forget what percentage we're at now, but, so the policy is that we shoot for that target. So we can certainly pull that ordinance out and that policy, and we'll share that as part of this, when I share the PowerPoint. So,
And the percentage we're at this point is?
yeah, Ms. Ambrose, do you have that percentage?
Yeah, I'll pull that up from the last Finance Committee report. Give me just one moment.
And a follow-up to that is, isn't there provisions in that statute for notifying the council when it goes over the 17%?
I would have to look. I know we have a policy that stipulates we have to notify the council if we go below and basically give you a plan to bring it back. But I don't recall whether there's anything in there as far as reporting if we go over. Maybe Mr. Sullivan or...
Yeah, Deputy Finance Director may have some.
The reporting requirement is what I thought we complied with when we realized after ending FY21, we were at 26%. So we immediately brought forward use of fund balance to pay down, convert bonded debt to cash. And we've so far, and one of the slides I did for FY22, I think we've committed or planning to commit a grand total of $9 million in fund balance this year. But you also have to count what was adopted during the FY22 budget, which was a little over $3 million. Then we had the $3.7 million with change of funding. Then we had 1.5 to capital reserves, $1 million going to the Economic Development Special Reserve Fund. So if we were to say what's the balance right now, we'd have to take those into consideration, and we'd be close to being at the 17%.
Okay. I'm sorry, Councilor Haney.
So I know there was a comment made about all our votes that we've taken on supplementary appropriations and how much money that we've made, but some of those votes that we've taken haven't been unassigned fund balances. Those have been ARPA funds, and those have been grants, or, so it's not, can you explain that to me a little bit better?
Yeah, that was actually covered in one of the
Okay.
slides that
Yeah, one
Mr.
of the
Ambrose did, the nine different groupings.
Yes.
Yeah, so,
It was like 17 million.
Yeah, so that 17 million, can I follow up, please? Yeah, so that 17 million, if I'm correct, is not funds coming out of the tax base, it's funds coming out of other funds from the state or federal government, correct?
yes.
So,
it's-
okay,
Yes.
okay.